All right, today we are jumping right in with a strategic playbook for one of the market's wildest stocks, Reddit. We're going to break down a plan that's specifically designed to handle its insane volatility.
So that really begs the question, right? How in the world do you trade a stock that has this much rocket fuel potential, but also this much risk? Look, the answer isn't to just close your eyes and hope. It's to have a rock-solid, disciplined game plan, and that's exactly what we're going to walk through.
And believe me, when we talk about volatility, we are not kidding. This entire strategy is built around one single staggering number, 76% annualized volatility. Now, a number like that, that's where fortunes are made, but it's also where you need to be extremely careful. Okay, so here's our game plan for this explainer. We'll start with the current situation, lay out the recommended strategy, dig into the specific entry points, talk about your safety net, define our profit targets, and then wrap it all up with a final takeaway. Let's get to it.
First things first, we need to understand the playing field. What's the story with Reddit stock right now? Well, it's really a tale of two completely opposing forces pulling it in different directions.
And this slide just lays out that conflict perfectly. I mean, look at the bull case on the left. The company is absolutely crushing it. Q3 earnings blew past estimates, revenue is up a massive 68% year over year, and they've raised their guidance for Q4. Analysts are loving it. But then you look at the bear case. There's that 76% volatility again. The PE ratio is through the roof at over 96, meaning its price is way, way ahead of its actual earnings. It's trading at 2.4 times the average for the tech sector. So you have this incredible growth story clashing with some pretty serious risk factors. And that's the puzzle this plan is meant to solve.
So how do we even begin to tackle this? Well, the analysis gives us a really clear, disciplined strategy that's built from the ground up to handle exactly this kind of risk. The heart and soul of this strategy is something called staged dollar cost averaging. Now, what does that mean? Instead of just throwing all your money in at one price and praying you got the timing right, which is basically gambling, this approach is way smarter. It's about buying in smaller, pre-planned chunks at different price levels. Think of it like dipping your toe in the water instead of diving in head first. It helps reduce the risk of buying at a temporary peak and gives you a much better average cost over time. And here's exactly how we break that down. Your total investment gets split into 3 buckets. We'll start with 30% for a more aggressive entry right away. But we're going to hold back 2 bigger chunks, 35% each, for more conservative entries, just in case the price decides to take a breather and pull back. Now, this is maybe one of the most important rules of the whole playbook, so listen up. The analysis is super clear. This entire Reddit trade, no matter how excited you are about it, should not be more than 3 to 5% of your total portfolio. That's it. This is how you contain the risk. It ensures that even in a worst-case scenario, you're not blowing up your account. All right, let's get down to the nitty-gritty. We're talking about the exact price levels for our 3 entry points. This table has it all laid out for us. So the plan is to get in with our first 30% of capital right around where we are now, between $208 and $210, just to catch the current momentum. Now, if the price pulls back, which it very well might, our conservative entry is waiting. We'll add another 35% at that key support level. And then, if we get a really big drop, our deep value entry is ready to deploy the final 35% at a major support zone that's historically been very strong. And here's the magic of this whole approach. If all 3 of those entries get triggered, look what happens to your average cost. It drops all the way down to about $192.53. Now that is a much better entry price than if you just went all in today, right? It dramatically improves your odds and your entire risk-reward setup. Okay, we've planned how to get in, but just as important, if not more so, is planning how to get out if things go sideways. This is all about setting up your safety net. And let me be absolutely crystal clear on this one. The analysis says with a stock this wild, a stop loss isn't just a good idea. It's not optional. It is absolutely mandatory. This is the one thing that will protect you from a really, really bad day. And this right here, this is the single most important rule in the entire playbook. The number to remember is $166.40. That is the ultimate line in the sand. Why that number? Well, it lines up with the 200-day moving average, which is a huge long-term trend indicator for traders. If the stock closes below that level, the plan is simple. You exit all positions immediately, no questions asked, because that's a huge red flag that the whole bullish trend is probably broken. So you might be asking, why would I take on all this risk? Well, it's because the potential reward is designed to be much, much bigger. Just look at this chart. The primary profit target we're aiming for gives us a risk-reward ratio of over 2.3 to 1. That means you stand to gain more than twice what you're risking. And that's the kind of math that makes for a high-probability trade.
Okay, we've covered our backsides with risk management. Now let's talk about the fun part, the upside. We need to have predefined levels for taking those profits off the table.
So, the plan outlines 4 potential profit-taking spots. Target 1 is a nice, quick gain at the first little speed bump of resistance. But the main event, the star of the show, is Target 2, sitting at $241.16. If we get past that, there are 2 more ambitious targets, one at a stronger resistance zone, and the big one, a potential retest of the stock's all-time high. Just hitting that primary target, that T2 at 241.16, represents a potential gain of almost 16%. That's a really solid return, especially when you think about the structured risk management we have in place protecting the downside.
All right, let's wrap all of this up and bring it together into a final actionable takeaway on how to execute this thing.
So here it is, the whole playbook boiled down into 5 simple steps. Step 1, start with your first 30% position. Step 2, set your limit buy orders for the other 2 tiers so they're ready to go. Step 3, the second you're in, you immediately place that non-negotiable stop loss. Step 4, you're aiming for that first major profit take at 241. And finally, step 5, as the trade starts working for you, you aggressively move your stop loss up to lock in those profits. You protect your capital.
This quote just nails the whole philosophy. With a stock like Reddit, your biggest enemy isn't the crazy price swings. It's your own emotional reaction to those swings. Real success comes from just sticking to the plan, day in and day out, with discipline.
And that really leaves us with one last thing to think about. In a market that feels so uncertain and volatile all the time, maybe, just maybe, the most valuable thing you can have isn't some secret stock tip. Maybe it's a meticulously detailed and disciplined plan, just like this one.